Welcome to Quarterly Market Update. I'm Emily. I'm Senior Financial Advisor at Perpetual. Today, I'm joined by our investment experts, Andrew and Hugo. Welcome both.
Thanks for having us.
Hi, Emily.
Could you please tell us what happened to the market at last quarter?
Yeah, so this quarter in equity markets was actually negative. So the MSCI All Country World Index was down about 2% in Australian dollar terms, and the ASX 300 down about 3%. It didn't start that way though. January was actually quite a good month for markets in general, as a lot of the thematics that we saw in 2024 that investors focused on, expectations that global growth would be robust, inflation would come down, and central banks would be able to cut, drove markets higher. There was also, importantly, people were thinking about Trump being quite good for markets at that point in time. So his pro-growth, pro-business tax cut agenda would ultimately boost the share market. But as we know, as the quarter continued, and he levelled tariffs against Canada, Mexico and China, and we had Liberation Day on April 2nd looming large, markets sold off in terms of that uncertainty around what would the new trade outlook and trade war look like.
Now you've mentioned the 2nd of April, Liberation Day. Tell us more. What's the significance of this date and what's driving the market to sell off?
So, of course, Trump famously named April the 2nd Liberation Day. He couldn't choose April the 1st because that's obviously April Fool's Day. However, one might think that he is the April Fool because when you look at the raft of tariffs he's announced, it's shocked markets. You know, when we go back to the start of last quarter, we had that quarterly market update titled "A Bull in a China Shop," which was very much emphasizing Trump's potential for disruption. You know, that idea of a bull in a China shop breaking things. And that's very much what's happening now. So what's actually happened, he's applied a whole raft of tariffs to basically most countries that have a trading deficit with the US. Now, Trump seems to have a view on economics that doesn't really meld well with most conventional economic thinking or most modern economic thinking. He seems to have this very mercantilist approach that if I'm spending money with another country and they're sending me goods, that's somehow us being ripped off. And of course, markets have taken fright to this. You know, from our point of view, what came out was very much within the scope of outcomes. You know, it wasn't shocking in the sense of we thought this could happen. We didn't know for sure this was what would happen. And to Hugo's point, the sort of sense that Trump would be pro-business was sort of something that everyone had as a hard assumption. Whereas now it's starting to look like he is, you know, acting very imperialistically. He sees himself as, you know, the strong man, the guy that's going to make America great again. And now he's throwing his weight around. And, you know, I think when you think about the cabinet around him, he doesn't really have many people who are strong enough to push back. And so this is the way he sees the world. And he seems determined to force it through. And, you know, when we look at the messaging, when we look at the structure of the tariffs, it's interesting to see what will play out. We're not sure yet what will play out. What we know for sure is that uncertainty has increased significantly, and that uncertainty is unlikely to go away in the next few months.
On the topics of tariffs, could you tell us how it's going to impact on Australian economy and its outlook?
Australia got hit with a 10% tariff from Trump in the Liberation Day announcement. But we do importantly have a large trade deficit with the US. So that means that we export less to the US than we import. And so despite that, we were still slapped with a 10% tariff. So based on Trump's calculations of how he was calculating the tariffs, it does seem unusual, but it does seem to be across the board. And it potentially could have been a lot worse. We look at China, we look at Europe, we look at Vietnam. They got selected and called out individually and got hit with a lot larger tariffs. For the Australian economy, it's important to remember that about 5% of our exports go to the US. So it's a very small portion, saying that the beef and wine industry is probably the sectors that will be hit the most, and potentially the steel and aluminium sectors as well. But the impact from the first order effect will be quite limited. What might hurt us though is the second order effect. So if global growth slows as trade wars escalate, uncertainty rises, businesses hold off on capital expenditure decisions, that's where it might, hurt the Australian economy and hurt our exports potentially to China that you touched on. Although there isn't, it's not all bad news at the moment. There is a silver lining that there is rumours that the Chinese government will stimulate forcefully. It's the bazooka that we've all been waiting for a little while now. And there's talks that might come. And that would be really good for Australia, as we would benefit from China trying to stimulate its domestic consumption and domestic economy.
Okay, thanks, Hugo. Now let's talk about inflation and interest rate. What are our latest forecasts for inflation and interest rate for both domestically and globally?
Yeah, look, it's a great question, Emily. And I feel like we've been talking non-stop about inflation and interest rates, well, since at least 2022. As we know, that this current bout of inflation was born out of the pandemic, where supply was disrupted and a lot of money was pumped into the system by governments and central banks. And that created a backdrop of inflation, and therefore that's why we had interest rates come up, because central banks are mainly tasked with killing inflation or managing inflation. What we're seeing now is a persistency in that inflation. And we've been calling that out for quite some time, this idea that inflation was likely to stay higher for longer, and therefore interest rates were likely to stay higher for longer. And that's very much played out. When we see this current environment, the main thing I would point to here is the disruption and that uncertainty. So if we think about it logically, if you're a business and you have pure certainty, I mean, this is obviously a hypothetical, but if you have pure certainty about what's coming in the future, you will run as efficiently as you can. You'll optimize your business, you'll buy all the right things at the right time, and you'll do that. Now, the reason I'm pointing that out is once you start adding uncertainty, it means you are unable to optimize your business. The more uncertainty, the less efficient you ultimately become. And what's another way of saying less efficient? It costs you more to do things. And so it's those costs that are ultimately going to feed into the system and keep a higher floor under inflation going forward. Now, add to that also the fact that that there is a global environment where there is a lot of swings and tariffs are being directly added to things. That then adds another layer to that. So what we think the current environment is doing is probably meaning that higher for longer situation continues. Unless, of course, what Trump does is drastic enough that he does actually create a global recession. And then, of course, the good news is central banks will be able to cut rates because, unlike a few years ago, there are actually rates to cut.
Finally, maybe some good news for the homeowner with mortgage.
Absolutely.
Yeah. What are your thoughts about the income-producing assets and the impact to the income portfolios as a result of rate changes?
It's a great question. I mean, the good news and we've been saying this for some time, it's taken a while because of investment structures and different things like that. But ultimately, interest rates dictate income across an investment landscape. And so with higher interest rates, income levels across portfolios are generally higher than they were a few years ago. We're hoping that will continue, and we expect it to continue. But of course, there are scenarios such as a recessionary environment, if that does come to pass, or indeed if earnings get really significantly hit. So here in Australia, for instance, we are heavily reliant within the Australian market for banks for dividend. When you think about the ASX, a large proportion of the dividends that are produced are by the banks. So if the banks, and we saw this during the 2020, during the pandemic, banks were banned from paying dividends for 6 months. And that was a huge hit for those people who are reliant on the income coming from portfolios. The good news is they eventually caught that up. But I guess what I'm saying is at the moment, the environment's probably pretty good for income moving forward. But of course, we keep saying this word, uncertainty. Things are relatively uncertain right now.
Now let's shift to Europe. Despite the recent market sell-off post-Liberation Day, we can see European market has performed relatively well compared to US. I've noticed Euro has also risen against USD, reached a new high since the last US election in November. Could you please tell us what are driving these new developments in Europe?
Yeah, there's a couple of things I'll touch on, but in all the noise that is occurring in markets at the moment, I think people have forgotten just the significance of 18th of March, where Germany announced that they'd be committing to a $500 billion infrastructure spending policy, as well as releasing or removing the fiscal straitjacket, as we like to call it, on the 1% of GDP defence spending over in Germany. So we think this is really a change in direction for the European economy or region. And we think it's really a signal that maybe they'll do whatever it takes, echoing what Mario Draghi said during or post the European debt crisis. So we think it's significant, and we've seen that, as you said, in European equity performance, it's done quite well. I think as well, we've also seen a rotation away from the US Magnificent Seven on the back of the most expensive pockets of the market that have done extremely well over the last 2 years. With all the uncertainty, particularly coming out of the US, clients or investors are reassessing where they should be positioned. Do they have enough diversification within their portfolio? So they're rotating out of the US at the moment and into the European economy and into European businesses, which have lagged really for the last 10 or 15 years. So it's nice to see that unloved sector get a bit more attention in recent times.
Yeah, I mean, the irony that Trump campaigned on making America great again and may ultimately make Europe great again is not lost on us.
Indeed. Thank you. Last question, the question I get asked a lot by my clients. How are we going to position our portfolios to navigate the current economic uncertainty and market volatility? What strategies are in place to both protect and grow our clients' portfolios?
Yeah, importantly, we aren't being reactive in this environment. We've been proactive. So we did think that Liberation Day and the raft of tariffs, whilst it has surprised markets, we did think it was in the realm of possibilities and the range of outcomes. It certainly was worse than expected and anticipated, but in the lead up to Liberation Day, we were making adjustment within portfolios. We were ensuring that we were rebalancing, so we weren't going into the period with large active bets, I guess, on one manager over another or one asset class over another. There's a lot of uncertainty in markets at the moment. In uncertain times, when you haven't got great forward visibility, it's important to stick to your knitting, stick to the long-term plan, and keep risk budgets low within that market environment.
We definitely saw this in the realm of possibility, thus us calling our last quarterly market update a bull in a china shop. So you know, we were relatively well positioned for this environment. We're yet to see the sort of audited numbers come out and really show us, but you know, things like the Magnificent Seven, you know, we were underweight them. You know, our discipline around valuations meant that we didn't have full value in those, and those have been the most heavily hit. So we're actually expecting that our protect and grow positioning will actually fare very well through the last month or so, and position us well for whatever comes next. So we're keeping our powder dry as such, so that when things do turn, when that forward visibility increases, that we can move proactively into that new realm.
Thank you, Andrew and Hugo. It's always a pleasure to have you both here. Thank you all for joining us. We look forward to connecting with you at our next market update. Until then, please take care and reach out to us for any further questions.